Hi guys, this is Oliver, your Bay Area Realtor, and for today's video, we're going to talk about the most recent rate hike from the Federal Reserve and how this may impact you if you're considering buying a home in the Bay Area. Before we begin, like this video if you want to see more content like this. Please subscribe to my YouTube channel for all your Bay Area real estate content. So to break down this video into sections, first we're going to talk about the Federal Reserve's most recent federal funds rate hike and the reasonings behind it. Number two, we're going to talk about inflation metrics. And number three, how stocks, bonds, and mortgage rates have reacted to the news. So last Wednesday on July 27th, the Federal Reserve raised the federal funds rate for a fourth time this year to 75 basis points, seeking to tame inflation. We look at the federal funds rate right now at bankrate.com. You see the federal funds rate this week is 2.5. A month ago was 1.75. So you see that 75 basis point hike. So we have the Federal Reserve FOMC statement that they issued to explain their recent increases. And this is what they said. Recent indicators of spending and production have softened. Nonetheless, job gains have been robust in recent months and the unemployment rate has remained low. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressures. The committee seeks to achieve a maximum employment and inflation at the rate of 2% over the longer run. In support of these goals, the committee decided to raise the target range of the federal funds rate to 2.25% to 2.5% and anticipates that ongoing increases in the target range will be appropriate. So when you read this, you see their reasoning why they want to increase the federal funds rates. They see that there's a lot of supply and demand imbalances, especially during the pandemic. We can definitely see that with housing, energy prices, gas, a lot of discussion about that. And so they want to increase the federal funds rate so they can tame inflation back down to 2%. So what that means is that for every year forward, they want inflation to increase at the rate of 2%. And right now, if we look at United States inflation rate on tradingeconomics.com, we can see how all these consumer metrics and goods that they've mentioned have increased. So it kind of dives deeper into what the Federal Reserve is talking about here. So right now, the annual inflation rate in the United States accelerated to 9.1% in June of 2022. This is the highest since November of 1981, from 8.6% in May and above forecasts of 8.8%. Energy prices rose 41.6%, the most since April 1980, boosted by gasoline, 59.9%, the largest increase since March of 1980. Fuel and oil at 98.5%, electricity by 13.7%, natural gas by 38.4%. This is the largest increase since October 2005. Food costs have surged 10.4%, the most since February 1981, with food at home jumping 12.2%, the most since April 1979. So we're seeing a lot of metrics here a lot of consumer metrics here that have been increasing at a very alarming rate. And we haven't seen these types of increases since the 1970s, 1980s. You can see with the chart here, you can see how inflation has been increasing over the past months to the year. July 2021, we're at 5.4% inflation rate. Now we're at 9.1% in June. So these are very alarming, and definitely inflation is at a very high point right now. So the Federal Reserve's goal is to have inflation at the rate of 2% over the long run. What this means is that they want inflation to be growing at 2% rate year by year. As you can see in this US inflation rate chart at usinflationcalculator.com, our inflation rate is at 9.1% so far, the highest since November 1981, and the growth of inflation has risen from 1.4% to 7%, and now to 9.1%. So we will likely see more rate hikes in the near future to combat this inflation. Let's move on to how this news has affected everything. Starting off with the stock market. There's a really good article from marketwatch.com how the stock market has reacted on the day of each Fed rate hike in 2022. The S&P 500 fell around 10% when Jerome Powell, the Fed chair, and his colleagues began the rate hiking cycle in mid-March, or 3 meetings ago. But the index they observed rallied at least 1.5% on each of the 3 previous Fed meeting days during this period. They have a really helpful chart right here that shows the S&P 500 during the days of the meetings on March 16th, May 4th, and June 15th. And then the shaded area is the post-meeting and how the market was reacting to the news. So you can see from the initial drop that occurred at 2 p.m. Eastern, the rate decision, all 3 times, there was a big drop, but then the stocks rallied for the remainder of the day once the press conference began. This is the same situation with Wednesday when the July 27th federal rate hike for 75 basis points occurred. The S&P 500 was up 1.5%, Dow Jones was up 1.29%, NASDAQ was up 2.59%, and the news conference was set to begin 2:30 p.m. Eastern. But since a 75 basis point move had looked pretty much like a done deal, the market was likely driven by Powell's messaging. So a possible explanation for the market gains was that they knew the Federal Reserve was going to hike interest rates. So a lot of consumers were expecting it because they were telegraphing it many meetings ago. So now let's look at treasuries. We can start looking at the 10-year treasury note. I use marketwatch.com for this. You can go to year to date and start off on July 27th when they increased their rate hike. We saw it's at 2.79%. And then when we moved on to the 28th, it dropped to 2.676%. Well, there was a little change that occurred during the Wednesday's meeting. Mortgage rates have a relationship with the 10-year treasury note. When the 10-year treasury note goes higher in the yields, the mortgage rates go higher as well, and vice versa. So in this case, it dropped, and rates dropped. We look at mortgage rates. This is from our website, selectiverealty.com. If you go to mortgage loans on the section over here, you can see that we have all the rates for a whole year. But let's look kind of closer to the 30-day mark for now. We have July 27th when the Fed rate increase occurred, and we can see the trend has been going down. But even before then, this past month, it's been trending down, but it's even gone even more down since the Fed rate meeting. And right now, these are our rates: 30-year conforming 5.259%, 30-year jumbo 4.916%, 30-year FHA 5.23%, 4.941% for VA 30-year, 30-year USDA 5.203%, and 15-year conforming 4.416%. So you see all these rates are still dropping. So this is a really helpful tool. You can check it out on our website. To re-emphasize what I was talking about with how Treasury and bonds and their direct relationship with mortgage rates, there's a really good article by forbescom, which is what the Fed's rate hike means for the housing market. Lawrence Yun, chief economist for the National Association of Realtors, he said the long-term bond market, off of which mortgage rates are generally priced, has mostly priced in all future actions by the Fed and may have already peaked, with the 10-year Treasury shooting up to 3.5% in mid-June. It is possible that the 30-year fixed mortgage rate may settle down at 5.5% to 6% for the remainder of the year, Still, mortgage rates are significantly higher now compared to 1 year ago, which is why sales for homes have been falling. So like what Lauren said, there's a direct correlation between treasuries and bonds and the mortgage interest rates. And what has happened is that the banks have already priced in all of these federal rate hikes that they were expecting already. And that is why the mortgage rates are not reacting to the most recent 75 basis point hike that was done by the Federal Reserve. Robert Heck, Vice President of Mortgage at Morty, he says buyers who have been waiting on the sidelines may see an opportunity to get back into the market as things normalize a bit and volatility wanes. While it may take years to play out, the Fed has made it clear that they will continue taking the necessary action to bring down inflation. The market has largely adjusted to this dynamic already. We've reached the new normal and it looks very different from the frenzied activity of the past 2 years, but that's not a bad thing, especially for you buyers. How does this affect you as a consumer? Well, the Forbes advisor has a really good article called "The Fed Raises Rates by Another 75 Basis Points, How That Can Affect Your Money." For the average consumer, increased interest rates have been the narrative. Buying a home is getting more expensive, but as you saw, mortgage rates have been trending down for the past month, and we may see some stabilization in the future. We saw that mortgage rates didn't move much after the federal funds rate increase. The bond market, which mortgage rates are primarily priced with, have clocked in the federal rates hikes already. So the main things that you need to look at as a consumer for these federal rate hikes is credit cards, for one. When the Fed raises interest rates, your credit debt becomes more expensive. That's because the interest rates on consumer debt, like carrying a balance on a credit card, tend to move in lockstep with the Fed's rate. The Fed's interest rate policy impacts how much commercial banks charge each other for short-term loans. A higher federal funds rate means more expensive borrowing costs, which can reduce demand among banks and other financial institutions to borrow money. The banks pass on these higher borrowing costs by raising the rates they charge for consumers. Most credit card issuers set your APR based on the prime rate, which is the rate banks charge the least risky customers for a loan. Most credit cards charge a variable APR based on the combination of the prime rate plus a percentage on top of that to cover both operating costs to make a profit. Mortgage and loans become costlier. This is more specifically for shorter term home loans with floating rates like adjustable rate mortgages or ARMs and home equity lines of credit that are mainly tied to the federal funds rate. So when the Fed's rate rises, ARM and HELOC rates follow as well. But on the flip side, rising federal interest rates are a good omen for savers who are seeing the interest rates on savings accounts creep up. There's no direct link between the federal funds rate and deposit rates, but banks are slowly increasing the annual percentage yield APY they pay on deposit accounts, including savings accounts, money market accounts, and certificate of deposits, CDs. Financial institutions raise their rates to attract deposits, but they currently have plenty of cash on hand and can take their time with hiking yields. So the two things you need to be concerned with these most recent federal rate hikes is, number one, your credit card balance and the APY that you have to take, the APR that you have to be aware of. Number two is the shorter term home loans, ARM loans, HELOCs. Those things could have higher rates, especially after that fixed period of time where the rates are being dependent and being changed based on the arrangement of the ARM that you have or the HELOC. But the good thing is you have savings accounts with APYs, annual percentage yields, that are slowly increasing, so it is an incentive to save money. So I hope you guys found this video informative. Please like this video. It helps my content reach others that may need this information. Feel free to subscribe to stay updated on all things real estate in the Bay Area.